The 4% rule is well known in the financial industry. It's been well tested and it's easy to apply to your retirement situation. Let's discuss how you can use it as a rule of thumb for your planning. Coming up next. Hey, this is Mel Stubbs. I'm a financial planner at Christy Capital Management, and we're trying to bring you good, pertinent information that you can apply to your retirement situation. So if you're here just for the information, please enjoy. Consider subscribing. But if you're needing some one-on-one help, then please click above to give us some information so that we can reach out to you. So where did the 4% rule come from? Back in 1998, 3 professors from Trinity University were curious to find out the ideal withdrawal rate. They did a wide range of withdrawal percentages ranging from 3% up to 12% on various portfolios with different mixes of stocks and bonds. They were also using a 30-year time horizon. The findings they came up with were using a 50-50 stock-to-bond ratio. Withdrawing 4% would leave the portfolio intact 30 years later 96% of the time. This means, for instance, that let's say you have $1 million portfolio that you've invested 50% in stocks, like let's say the C fund, and 50% in bonds, so let's say the G or F fund. It means that you could withdraw 4% of the balance each year for 30 straight years, and there'd be a 96% success ratio, meaning that your portfolio would remain intact. Now, this is a simplified view. We aren't accounting for tax implications or timings of when the portfolio may fail or inflation or anything like that. So one of the big takeaways from this is that if you can live off of 4% of your portfolio, then you are effectively financially free. Now, for the federal retiree, you're going to have a federal pension. You're going to have a supplement if you retire earlier than 62. At age 62, you can turn on Social Security whenever you want. So you're going to have 2 other guaranteed monthly payments coming in from Social Security and from your pension. So when you take that into account of those 2 guaranteed income sources, you need to subtract that from your monthly expenses and you'll come up with your shortfall. Can you meet that needed shortfall by withdrawing 4% or less of your money? If you can do that, then effectively you are financially free. Now, in doing my research, I found a website that did their own study and they used different portfolio percentages. Do you think the portfolio does better when it's more aggressive than 50-50? Well, if you look here, we're still using 30 years as the benchmark. They got the highest success rate when they only had 10% in stocks and 90% in bonds with a 99.11% success rate. In this study, they were showing that the 50-50 combination over 30 years has a 92% success rate. Now, I know one of the things these charts don't take into account is the ability to have flexible income. In real life, the stock market, if it's doing poorly, a lot of times people will withdraw less during those years. But for this study, they were always using a fixed percentage of withdrawal. It also doesn't include extra income, meaning taking out more during good years. So what's an easier way to apply this 4% rule? If you take your annual expenses in retirement and you subtract out what you think your pension will cover and what Social Security will cover, then you will have your remaining expenses. If you multiply those by 25, that will give you the amount of money you need to have to be able to withdraw 4% to pay for it. So let's say that after your pension and Social Security, you still have $20,000 a year of expenses that you need to pay for. $20,000 times 25 equals $500,000. If you withdraw 4% every year from $500,000, you would withdraw $20,000. So another takeaway from this is to use this as a guideline, not a hard and fast rule. This should put you in the ballpark of a reasonable withdrawal rate that you can have and still maintain the portfolio. Stock markets are volatile. Interest rates change. There will still be decisions that you can make along the way that will help ensure the success of your portfolio. Another takeaway from this is that it's not as important how much money you've saved. What's really important is the amount of your expenses. What expenses do you have? If you're able to spend less, then you'll not need as much money saved in order to be financially free. I've talked with people that have had $500,000 and were totally free to retire. I've also talked with others that had $2 million, and based on the expenses that they wanted to cover in retirement, they were not able to retire yet. So a lot of it is determined by how much you want to spend. What lifestyle do you want to have in retirement? Another takeaway from the research they did at howtofire.com was that being overly aggressive did not necessarily make the portfolio last longer. I would have initially thought that over the years, the more aggressive you were, the more likely you'd have success. But with their study, they had 98% success rate for 30 years with only having 10% stocks, 20% stocks, and 30% stocks. That's relatively conservative. One of the things that's always ignored in these studies is the tax implications. If we use the example when someone has $1 million balance, that means they can withdraw 4% or $40,000 a year to pay for expenses. But what if the $1 million is in Roth? That means there would be no taxes and they can withdraw the $40,000 a year as long as they're over the age of 59 and a half and as long as they've had their Roth IRA for 5 years. Well, that sounds awesome. But what if the $1 million is in traditional? Either traditional TSP or traditional IRA, if they need $40,000 to live on after taxes, they will have to take out more than $40,000. Let's say they're in the 22% tax bracket federally and they're in the 5% state taxes. That means they need to withdraw $54,794 each year to get the $40,000 after taxes. That means they're not withdrawing 4% of their money, they're withdrawing 5.4% of their money. That extra 1.4% makes a big difference in the probability of the portfolio lasting. So the fact that the study has ignored tax implications makes this just a rule of thumb, but not something that you can bank on in retirement. Because tax implications make a huge difference. Where you store your money, meaning the type of an account that you use, make a huge difference. You've got taxable accounts that don't have any special tax treatment. You've got traditional accounts that let you postpone taxes. And then you've got Roth accounts, which you've already paid the taxes. So when you take the distribution, there are no taxes. It makes a difference where you hold your money. As you're working towards retirement, it's important to make sure that your balance is high enough to cover your expenses. But it's also important to store the balance in the correct type of an account that gives you the best chance for success. Having to withdraw taxes at retirement sounds good when you're starting out in your career and you get that tax deduction on the contribution. Traditional accounts let you postpone taxes, and isn't that great? Well, it sounds great until you get to retirement and you realize that you actually need a bigger balance saved up to be able to take out the amount that you need after taxes. So if you need help determining what withdrawal strategy works for your situation, meaning do you have enough money to retire, please reach out to us at christycapital.com. If you have $400,000 or more of TSP money, that we can help you invest, we can do a full financial blueprint for you, showing you your income, that you'll have with your pension, showing you the income you'll have with Social Security, and it'll show you the withdrawal amount that you need to fund the lifestyle that you want. Making sure that you have enough to fund the lifestyle that you want is important. If you want to work with somebody to help you figure these numbers out, please reach out to us at christycapital.com/federal, where you can get some good federal information. You can also click on the Talk to an Advisor and talk to me one-on-one about your situation. This is too important to mess up. Please let us know how we can help you. I'm Mel Stubbs. Please check out some of our other videos. I'll talk to you next time. We need to do the proper disclaimers. The purpose of this video is not to give specific tax advice or investment advice. We're going over general principles and ideas that can be used, and if used correctly can save and avoid taxes. You're going to want to work with someone personally who knows your situation personally, so seek out advice from an independent financial advisor. This is for educational purposes only. I hope you enjoyed the video.